Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT, keeping expectations in check. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, in this video, I'll kind of be giving it'll be kind of a mashup, if you will, because I didn't have a chance to make the weekly close and the weekly open. Some things have come out, meaning non-farm payrolls, ISM services for today. So I'll kind of tie everything together. And really what will be the glue that keeps everything together is the idea that it's always best to keep expectations in check. And the best place to start, in my opinion, is the non-farm payroll report. Now, I have various ex-profiles in my description of people that know way more than I do on the labor market, mainly Macro Edge, Danielle DiMartino Booth, Amanda Gorol, which I should actually put in the description because she has a lot of little nuances that are quite interesting. Just for a tidbit, today actually marks the beginning of student loan repayments starting again, which again isn't a doomsday factor. It's just one of those things that will act as a headwind to the economy, right? And so look out for retail sales in the months ahead, as people see their credit score potentially get lowered because of bad debt. But in any case, segues aside, although there are many nuances, and again, if you want to follow them, if you want to, get a hold of them, go in my description. However, a 177 print is usually an indication that there is still growth. All right. Now, may it be pristine? Is it the definitive number? Absolutely not. In fact, with this non-farm payroll report, we actually got about 60K, 50, 60K revisions to the months prior. So we have March that came in lower at 185. It was actually 220, something like that. And same thing for February. All right. We were about at 150 and now we're at 117. And right here, what you have is the final revised numbers for 2024. These are the numbers that the QCEW, the Quarterly Census of Employment and Wages, which it's basically what the QCEW does. Basically, it does what the BLS does, month over month, except they take quarter over quarter and they make an analysis that is 10 times bigger than the BLS, basically. All right, and this is usually as accurate as you can get with the jobs data. All right, and this is what you'll see when you read, or if you read actually articles about, there were less 600K, 800K fewer jobs added in 2024 than previously thought. And again, why do I bring this up? Because if you look, for example, in January of 2024, the first print, they got revised a couple of times. Regardless, we were at 256. The final number for January 2024 was about 120. Same thing for February. We were about 236. It got revised lower, and then it got revised lower at 222. It isn't as obvious. Again, March, this is probably a better example right here. We were at 310. Then we got lowered at 246. The best example, I think, is actually June. Yes, June. June got cut in half. Same thing for August. Got cut in half. And, the rest of the months were more or less the same. Why do I bring this up? Because, first of all, the market reacts on what it has, not on what things might be. All right, and that is something that you must consider, because again, if you look at these numbers right here, or even the revised number for February, All right, I remember saying, giving 105, just for the fun of it. I said 105 and I think 4.1 on the unemployment report. And it came in at 150. And I thought, yeah, well, I was off by a bit, but not that by that much. But then it gets revised lower to 117, and all of a sudden it's like, wait, I wasn't off by that much. And it's not, what matters really isn't, my personal forecast. It's that at the end of the day, these numbers will get revised. And usually when you're in a slowdown, such as the one we are now, they usually revise lower. When you're expanding, you'll usually see revisions to the upside. All right. Right here, and this part here, you usually saw revisions to the upside, meaning the BLS was underestimating the strength of the economy. Right now, if I had to, give my best guess, I would say that the BLS is currently overstating jobs. All right. And again, this will continue to play out in the coming months. And again, it's important to keep expectations in check. 177 might get revised low. I don't know. We might get to 75K and I might end up being right. I have absolutely no idea. But generally speaking, 177 is still kind of okay. It's good. It's a good number and is an indication that, as I've been pointing out many, many times, we should stay away from the temptation of looking at something that, this is going to be it. This is going to be the smoking gun. Instant gratification, meaning that, yes, we have all of the soft data hinting towards things. But again, do we have negative payrolls? No. Do we have the unemployment rate at over 5%? No. Do we have initial claims skyrocketing as if, the recession is peaking? No. So the market will trade based on what it has, not on what we think it might be. It gets 177, TLT sells off. It gets 75K, TLT goes up. All right. And again, I maintain the stance that this is a process and it'll take some time. I've laid out that process in my previous video, my last video. And again, for anybody who hasn't watched it, the idea is basically this, that, and again, this is just me saying how it might happen, right? This is me imagining a possible, recession actually culminating, is that I expect some kind of strength leading up to the summer months and kind of a repeat of what we saw last summer, where you kind of saw non-farm payrolls kind of get weak, all right? Quite weak. What will make the difference, what I speculated on my last video, is that what will make the difference is these months right here, September to December. Because again, last year we had a lot of transitory events, as I called them. Tariff front running, the beginning or at least of tariff front running, natural disasters, perhaps sprinkle in some election euphoria with, the Trump presidency is going to be, incredibly pro-business, business friendly. A lot of things that perhaps made the economy look better than it was and inflation look worse. My speculation is that what if we get some of the weakness during the summer, but we don't have all of those transitory events from September onwards to fall back on? And that is potentially where you might see, some of the stuff hitting the fan, all right? But again, that's just my speculation, and I could very easily be wrong. I was wrong about I get a lot of things wrong. I mean, that is one thing I want to say clear. I want to make clear. It's kind of like the guy in The Simpsons there. When Homer is watching the pundits, and there's that old geezer on TV, and he says, well, folks, when you're right 52% of the time, you're wrong 48% of the time. It's kind of like that. I'll get things right. I have gotten things right ever since I started making videos. Got a lot of other things wrong, but that's just the way things go. So again, as far as the non-farm payroll report is concerned, it was a good number. Watch out for revisions, and actually keep an eye on the summer. All right, we're not gonna get just a collapse. No, I'm not expecting spikes. I'm expecting it to play out throughout the months. All right, I'm what I called a process basically. It'll take some time, but eventually I do believe we'll get there because there are certain things that we've looked at it many times that were already in play well before the tariffs. And actually, you kind of get the hint that a lot, the tariffs are kind of painting over. I mean, rather than painting over, how can I put this? They are providing a good excuse to lower expectations that were probably a little too high going into the year. I'll put it like that. As far as the unemployment rate is concerned, we actually did get labor force participation rate shenanigans. All right, it actually went up. We were at 60.5, and again, yeah, I'm pretty sure this is the correct read right here. And again, another thing that I was not expecting, but I said I wouldn't be surprised by a move up in the labor force participation rate, because again, if you look at what happened in 2006 and 2008, and that cycle right there, the labor force participation rate really just stayed. It actually went up as we went into the recession, and it actually just stayed right here in the middle. I mean, it could easily draw kind of a middle of the line here. Let's actually do it. Let's do it live, as Bill O'Reilly used to say. Right there, and only after like the worst part of it, Lehman Brothers, it actually started declining. So again, I made the case that potentially we might be seeing some similar dynamics where actually the labor force participation rate moves up and maybe even reaches 72.6, 72.7, 72.6, 72.7, around this range here. And then as we get through the summer, perhaps we see it go down if we get, that hard landing scenario. However, this alone wasn't enough to push the unemployment rate up to 4.3. It stayed flat at 4.2. Again, my speculation was that base case, I was expecting 4.2, but if we got labor force participation shenanigans, we could perhaps see 4.3. Now, the unrounded unemployment number for the month of April was 4.187 compared to 4.152 in March. Now, it basically isn't anything dramatic. However, I will call into play initial jobless claims. It will be interesting to see initial jobless claims. Now, I've said it before, initial jobless claims, as far as I'm concerned, aren't a reliable, thermometer or gauge of the labor market. If you look back at history, every time, if you wait rather for initial jobless claims to actually break out, something's already happened, and it's like saying, again, I'm not going to do anything. I'm not going to stimulate the economy until I see initial jobless claims spike. Wrong, because that is like saying, again, I'm not going to shower until I smell like rotten eggs. Shower before you smell like rotten eggs. All right, don't wait till you smell that bad to shower. Don't wait to stimulate the economy until initial jobless claims at 700K. However, I will be looking at them with a little bit more interest this month because we do have a 241 print, for last week. If we continue to see initial jobless claims stay above 220, which has kind of been the demarcation line as far as I'm concerned for moves in unemployment rate, if we see the initial jobless claims stay elevated over 230, again, these could easily crash down lower to 212 or something like that. Again, but if we do see them stay consistently above 220, the fact that we are at 4.187, again, if you see initial jobless claims pick up in a significant manner, meaning they stay well above 220, potentially 230, around the first 2 weeks of May, it could make the case, first of all, for 4.3 in the month of May. And if things stay well above 230, you could actually start thinking about 4.4 in the month of May. All right. So I would keep a special eye on initial jobless claims, given the fact that we are very close to 4.2, and it wouldn't take a dramatic move, basically just 0.6 at this point, to put us at 4.4. All right, because it would put us at 4.5. It would just basically round up to 4.4, give or take. So a special mention to initial jobless claims, which actually a forecast of 232 for the observation period of April 26th. So again, special focus on initial jobless claim this week, just because, these coming weeks, because again, given where we are on the unrounded number, it doesn't really take that much to push us up. All right. So keep an eye on that. Actually, I was for 4.4 is actually, now that I think about it, a bit too exaggerated. We'd have to see something, quite dramatic on the initial jobless claims. Base case, it puts us in a it just puts 4.3 in sight. All right, then if we do see something a little bit more dramatic, 4.4 might be in play, but it's a little extreme in my opinion. So keep an eye on initial jobless claims for that. Then today we had services PMIs. Now, overall, this is probably one of the best reports I've read. Ever since February, this is probably the first report which at the very least isn't as pessimistic as the ones I've laid out in my previous videos. Again, does it scream optimism? Does it scream rainbows and sunshines ahead? No. Take, for example, uncertainty remains a dominating theme as the US government has been maddeningly inconsistent with tariff implementation. I know we have this tariff drama. I would also put in Doge, and again, the way Doge is operating, and what I'm interested in is that, if you lay off even just one federal worker, that federal worker has to deal with the private sector, and whoever he or she or they deal with, whatever you want to use, whoever they interact with will be affected by the layoffs. All right, so I would keep that in mind. But regardless, this isn't a bad report. All right, this is probably the first good report that I've read ever since February, and of course, TLT didn't like that. All right, probably one of the only things I got right last week was that we were in a good news is good news and bad news is bad news environment. All right, and just to briefly go over TLT, what I will say is that, again, keep expectations in check. Right now, I think that this move right here is more of a symptom of lack of bad news. And so we know that there is a slowing, but now we're really just plowing through the more inflationary rhetoric or narrative, because again, we don't really have any indication right now, it's smacking us in the face that the economy is falling off a cliff. We don't have any indication that non-farm payrolls are negative, for example. We don't have sky-high initial jobless claims. However, we do know that the US government isn't stimulating the economy as much, all right, at the margin. We know that tariff uncertainty is acting as a further slowing on the economy. But we also know that tariffs are pushing prices up for the time being, because again, rather than just tariffs, it's that everyone is just rushing to grab whatever they can on the open market, and that is actually bidding up goods. So again, as for the time being, what can the market go off of? What can it price in? Well, the inflationary side. And inflation is very, very bad for for bonds, especially on the long end, because again, the main dynamic, again, this I strongly believe this. I could be wrong, but the main dynamic that pushes price, that moves price on the long end of the curve, is, well, growth and inflation expectations. If inflation expectations are rising as they are now, well, expect investors to demand a higher premium. And that's exactly what they're doing on the long end. All right. Whenever we start getting the bad news, I expect the inflationary side of the story kind of to dissipate. And again, I'm not saying that inflation, we might not actually have, inflation go up from now on, just because, again, the pull forward has been so strong. What I'm saying is that eventually, and this is kind of the red line, I mean, the line of the sand, really, if things stay like this, even if you were to see, like we saw in 2008, a sharp uptick in inflation, eventually it'll drop like a rock. And this actually ties back well to TLT. And again, I've said this before, but I'll say it again now. What is the one thing that makes today different from 2022? It is actually the thing that would actually make me very, very bearish on bonds if it would happen. That is stimulus. We are lacking stimulus in the economy. And again, yeah, you might say you can easily point towards the government, and all the spending. And yes, we still have a 6% deficit. I'm well aware of that. What I'm talking about is, do we have direct transfers to population? Meaning, do we have any stimulus going on? Packages like we had during COVID and directly after COVID? Do we have credits for employment? Do we have, again, I don't know, $1,200 being shipped to every American's bank account like we had during COVID, pushing up demand? No. Will the tax cuts push up demand? Well, if they are new tax cuts, yes. If they're the old tax cuts just getting renewed, no. So that is actually the one thing that I would pay attention to. Do we get some form of, again, big stimulus package? Call it, I don't know, Doge dividend checks, as Musk talked about a few months ago. Just to throw out a crazy example, anything of the sort, that would make me bearish on bonds, because we are currently in an environment where we just don't have much of the demand at the moment. All right. Yes, everyone is pulling forward, but given the state of, and we talked this about many, many times, for example, the labor market and what people in the labor market are telling us, they're telling us that the labor market isn't as hot as it was in 2022, meaning that they are acting in a more defensive manner because they don't have the chance or the opportunity to switch jobs and that actually pushes wages up, because again, if you can switch job, you can use that as leverage against your current employer, or switch job outright and get a higher wage. They don't see that. They don't have that at disposal. So they're hanging tight because they know that also if they lose their job, lo and behold, this happens. It gets harder and harder and harder, at least compared to 2022. It gets harder to find a job. So if, for example, you lose your job, well, most likely going to sit out of the labor market for quite a bit. All right. And again, going back to the quits rate, a low quits rate is an indication that wage growth is likely to be sluggish. All right. Sluggish wage growth, sluggish consumption, and everything just kind of piles on itself at that point. So again, are we in a position like we were in 2020 and from 2020 to 2022, where everybody was just, the economy was red hot. Everybody's chasing a higher wage. We're at the opposite side of the spectrum. What could definitely add fuel to the fire is, again, a stimulus package. Do we have anything that will spur demand? All right. And if we do, at that point, I would reconsider the bullish call on TLT and the long end of the curve. Because at that point, it comes back to a growth and inflation expectations. Now you have high prices, but you don't really have the demand, right? So eventually, my base case is that the low demand or the lack of demand will pull everything down, right? And actually end up in a recession. But if you have high prices, because of, all the pull forward, and you introduce a positive demand story to it, well, at that point, it's really hard to be bullish bonds because, again, growth and inflation expectations would dramatically rise, and bonds would, at the long end of the curve, would easily go above 5%, probably head for even 6 at that point. They could even go there regardless. I could easily be wrong at this point too. But that is kind of my line of the sand for TLT. Again, other things like, Trump firing Powell or the US heading for a fiscal crisis, that is always touted by, the doomsdayers. Those are the things that kind of make me rethink the bond call. As far as things are concerned right now, nothing is surprising me, all right? I've always expected this to be a process. I never expected this to be to end up with a spike. It'll be a process. And my instinct tells me it will be during the summer that we will see some of the results of all of this, of the tariff drama, of the uncertainty, but also of what was already in play and what was potentially hidden by all the transitory events we got from September till January. So we are in a bad news is bad news environment, good news is good news environment. Do we get a positive news headline for the economy? Well, like we did today, if we do, bonds will sell off. And I think that bonds at this point are a little bit more susceptible, simply because our expectations is that, yes, because we have all of this soft data, it's kind of like, we're there in trepidation waiting for this to happen. And I think that it will happen exactly when everybody stops waiting for it to happen, all right? Like, let's say that even May's non-farm payroll report is okay. Let's say we get 100K and 4.3. At that point, everybody will say, yeah, you know what, the economy's still hanging in there. There's no reason, to go long duration. There's no reason to be worried. Maybe at that point, it actually happens, all right? Because again, we have all this soft data pointing to, imminent doom, or rather that is how it's being interpreted. And we keep on waiting for the smoking gun, the spike, that one report to solve it all. When in reality, in my opinion, I still maintain the idea that it will be a process and it'll take months. And again, my first checkpoint has always been and will be the summer. Keep an eye on the summer. Keep an eye on how the economy ends up being during the summer. And just to follow up, if you recall, just to look at something like jobless claims, which again usually lag, but regardless, last year they bottomed in January, they peaked in July, and we didn't really have any drama to kind of exacerbate this move right here. This year they bottomed in January. We do have a lot of things going on that might exacerbate this. So all eyes on summer. Let's see how things play out then. One announcement before I finish the video. The summertime is usually my busiest time of the year, so I won't be making videos during the weekend. Friday through Monday is usually the busiest days, so the rest of the days will be the same, but from Friday to Monday, don't expect videos. But again, if you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.